Arbor Realty Trust currently offers a forward yield of 14% and has some very strong financial metrics that we will touch upon. So is this company undervalued? It is down 10% year to date, trading towards its 52-week low. Let's find out. As always, we are going to look at the historical performance of the company, looking at their top line as well as their bottom line net income growth over the last 5 years. We're going to look at the health of the company, their balance sheet, total cash versus total debt. We also want to look at other mortgage REITs to see how they've performed on a total return basis over the last 5 years, including those dividends reinvested. And as always, we want to look at the institutions. Are they buying? Are they selling this company? And all important, looking at that dividend safety. Is it safe? Can we invest, ensuring that this yield will continue to be paid out over the coming years? As well as some strong financial metrics that we will touch upon, and we will look at the earnings that they did have recently. And as always, we will put them through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given that investor margin of safety. So let's jump straight in it. They are down 10% year to date. Now, investors who have been holding the company over the last 10 years would be up a very positive 86%, especially when you consider it doesn't include those dividends reinvested. And you can see it did peak towards the back end of 2021 at around $21. Now it is trading towards its 52-week low with a forward yield of 14%. So is this a strong company that we should be looking at, where we can expect the share price to double and see that yield on cost grow to 20-25% over the next few years? So let's start with their income statement. Now, typically for REITs, we do like to see around 5 to 10% growth year on year on those total revenues. And we can see for ABR, they reported around 348 million on the top line in 2018. 5 years later, their latest annual report, December 22, they reported around 654 million. So that is some nice growth over the last 5 years, nearly double. And we can see from the trailing 12 months, they are looking like they will increase on their December 2022 figures as well, which is positive to see. On a more granular level, we do see increases from 2018 all the way, in fact, to 2021, before a slight drop in 2022. Nonetheless, over the last 5 years, very positive growth, and we will touch upon the last 10 years percentage-wise too shortly. Now, looking at that bottom line net income, does it tell the same story? Well, 116 million reported in 2018, 326 million in 2022, so nearly 3 times growth on the bottom line, which is always positive to see. And again, when we look at it on a more granular level, a very similar story, growth to 2021, before remaining fairly flat, a small drop in 2022. And again, positive to see that trailing 12 months looks like December 23's report will show some nice growth. So positive in my opinion on both the top line revenue as well as their bottom line net income. Now total cash versus total debt, a quick health check. Well, 160 million December 2018. Latest annual report or quarterly report, in fact, 895 million. So very, very large increase for the company on their cash position over the last 5 years. How does that compare numerically and directionally? Well, we can see total debt has gone from 3.4 billion to 12.4 billion. So that is quite a large jump, especially when you consider their cash increase. So that will be something that we will look at when we look at that all-important dividend safety. So let's touch upon a few other customers, or in fact, companies in the mortgage REITs industry. Now we have AGNC, RITM, and BXMT. So remember, the total return for year to date is effectively those dividends reinvested. And with ABR, you would be up around 1.24%. Now, it is one of the worst performing of their peers. And realistically, any investment you want to be at least keeping up with inflation around 4%. So not the greatest return year to date. If we expand that to the last 5 years, how does ABR essentially fit into that? Well, they would be up, as we can see, the best performing of the four, 67%, which is fairly positive to see. Remember, though, this does include reinvesting those dividends. One thing also to bear in mind, as we always say on the channel, past performance is never indicative of the future, so do bear that in mind. Don't base any investment decisions on the past. So 83% institutional ownership, 10.5 billion worth of sales from institutions over the last 12 months, with 84 billion inflows over that period too. So institutions are loving this company. They are buying significantly more than they are selling, with a huge buy or inflow of 75 billion in Q2 of 2023. So they do have a lot of faith in this company. Again, please do bear in mind that we do not copy what the institutions do, and we need to always do our own due diligence. Very quickly touching upon their essential earnings call from September 2023's quarter, we see that earnings per share was expected 45 cents, while they beat with 10 cents, reporting 55 cents, a 21% surprise. And on the top line, 98 million was expected, 107 million reported, so another beat, which was very positive to see. If we go back on the quarter before in June, we also see a double beat, so very positive to see. And very briefly comparing that quarter, September 23 to September 22 year on year, beat the top line by 19%, bottom line 21%, diluted earnings per share by 14%, bottom line net profit margin increase, as well as an operating income. So very positive to see on that year-on-year comparison. We do see, however, a decrease in their net change in cash, but otherwise very strong performance from ABR on their earnings. Now let's take a look at that all-important dividend safety. At the end of the day, if a company is paying you 55% yield, you want to make sure that it is safe. Otherwise, it doesn't matter what that yield is, no matter how high it goes. So market cap 2.29 billion. It is a mid-cap company. Now, very quick recessionary metrics. So they did in fact cut their dividend during the last recessionary period of 07-09. Negative 381%. Now, this is not surprising given it is a mortgage REIT, so that is expected given the crash of 07 and 09. And the recession return, again, negative 96%. It isn't one that is surprising given the company and the industry. And we can see it significantly underperformed the S&P's negative 55%. Dividend growth, double-digit increase, 11% over the last 4 years, 16% over the last 5 years, 15% over the last 10 years. So some very strong dividend growth over this period that we've analysed. And we can see they have been paying increasing dividends over the last 10 years. So that is always good to see in any company that you invest in. Now, dividend yield theory, what does it state? Well, it says a company is undervalued when that current yield sits above the 5-year average. So we have our first sign of undervaluation. Likewise, forward PE sitting below the 5-year average, a second sign of undervaluation. But bear in mind, we're not looking at any of these models in isolation, and we will draw a conclusion towards the end of the episode. Another sign of undervaluation with the PE significantly lower than the sector PE of 10.4 for financials. And yes, it is trading towards the 52-week low, but as we always mention, a 52-week low never signals undervaluation. Likewise, if a company is at a 52-week high, it is not an overvaluation signal. Now, typically on the channel, we only look at the free cash flow as the earnings is susceptible to manipulation by management. But for mortgage REITs, this is a lot more volatile, as you can read here. So we tend to effectively ignore the free cash flow and stick to the earnings data. Below 95% is what we're typically after for mortgage REITs. And this is essentially a lot higher than the 60% that we look for in normal companies, especially with the REITs in general. Now, the reason for this is REITs do tend to pay out the majority of their earnings through dividends. And what we can see over the last 10 years, it has been fairly mixed from 2013 to 2015, significantly over. But over the last 3 years, below that 95% in the low 70s, although 2023 is expected to go up slightly higher. The one thing to look out for, you don't really want to see this go over 95%, because what this is signaling is, for example, 2015, the company paid out a lot more in earnings, 130% more in dividends than what they earned, which is a red flag, but it has been under control over the last 3 years, so just bear that in mind moving forwards. Again, we tend to typically look at the free cash flow per share as well, but for this company, for REITs in general, a lot more volatile, so we stick to the earnings per share. 31 cent in 2013, 2.23 in 2022. It is expected to come down slightly in 2023, but nonetheless, it is moving in the right direction consistently, and some strong growth over the last 10 years, in fact, as well. Sales growth, again, we can see whilst mortgage REITs do not report revenue like other companies, we tend to focus on the net income, which was part of the revenues when we analyze their income statement. And we are seeing some nice growth over the last 10 years. Now, focusing on the sales, the top line figure, 85 million in 2013, 654 million in 2022. So some strong growth. And if this does continue, this could be a very dark horse within your portfolio with that very high yield. Now, shares outstanding, it is typical for REITs in general to dilute your position as a shareholder by issuing shares that we see. Different REITs will dilute your position quicker or slower depending on the nature of that company, and we can see from 43 million in 2013 to 119 or 199 in fact in 2022, so that is fairly high. So again, just some pros and cons with every company, so do bear these in mind. Now when we do take a look at that ROE figure, return on equity, 10% or more gives us faith that management are effectively allocating their capital, and we can see for the large part it has been in fact above that 10%, which is positive to see. Now when we move on to that net debt to EBITDA, which is what we typically look for, it isn't meaningful effectively because the EBITDA for mortgage REITs has interest as a main component of their revenue and expenses. So now what we're going to do is jump into the valuation as we have run through Arbor Realty Trust. And as always, if you do enjoy the content, value is being provided, do smash that like button, hit the subscribe bell if you want to be continually notified of these videos as they drop. And if you want to grab a copy of the valuation model that we're about to run through, to get to the intrinsic value and acceptable buy price of companies in your own portfolio, then do click on that pinned comment below. As always, as we say on repeat, Graham's valuation isn't applicable for REITs. It's also not applicable for companies that have double-digit, fast-growing revenue year on year. So we will not be including this in our final output. However, if you do want to know what we typically do, we have the stock ticker, the earnings per share, the growth rate per analyst estimates, and that current yield on AAA corporate bonds, remembering that current yield, the higher it goes, the lower that intrinsic value is pushed. So we move on to the first model, the REITs multiple valuation model with companies in a similar sector and size that we analyze. We have AGNC, RITM, and BMXT. Now we have their stock price, earnings per share with their P multiple. We have the average, multiply that by the earnings per share of ABR to get a stock price of $26. Now when we take a look at that, we can see that is significantly higher, in fact more than double the current trading price, and above the 52-week high, showing signs of undervaluation in the current market. But do bear in mind, we don't look at any of these models in isolation and draw a conclusion as a whole towards the end. We then have the yearly dividends for our dividend discount model. Very strong growth over the period with around 11.5% on average. Now I have gone a lot more pessimistic at 2%. If this company is to continue pay those high yields, I do feel they will struggle to keep up with these high mid-teen digits increases, although we did see a slightly smaller one. So I have gone for 2%. Again, I know investors will be saying you should go much higher. Some that may say you may go lower. So as always, if you do want to play around with these numbers, grab a copy of the model and you can put in your own numbers. So this gives a DDM price of $28.56. Again, more than double the current trading price and above that 52-week high with our second sign of undervaluation. We then move on to the third model we're using in today's episode, the DCF discounted cash flow model with our free cash flows year on year. Average growth rate 52%. We have gone much lower in line with analysts. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding to give a DCF price of $18. Again, that is right there at that 52-week high, some significant undervaluation to the current market price. And don't forget, you are locking in a fairly high yield. So as that share price goes and that dividend yield grows up, you will be locking in a higher yield on cost. Now, the intrinsic value, as always, is just the average of the models that we are running through. And don't forget, if you do enjoy the content, value is being provided, do hit that like button and subscribe and hit the bell so you're coaching notified as these videos drop. Remember, 10% margin of safety is what we'd use if we believe it has a wide moat, strong financial metrics and good forward-looking data. But do bear in mind, with the mortgage REIT industry, there are always going to be a ton of risks to bear in mind. Now, margin of safety with this company, for those that are looking for a much higher margin of safety, it's still a buy with a 30% margin of safety. At 40%, it's still a buy, and at 50%, you would be looking roughly a few cents off the current trading price. So you could argue right now you are looking at a 50% margin of safety based on our estimates and judgments in each episode. Now, Wall Street, what are they saying? Well, they believe there to be some nice upside to the current trading price, just shy of 50%. So based on our estimates, you're locking in a margin of safety of 50% while also having 50% upside per Wall Street analyst and locking in that very high yield. As always, if you do want to grab a copy of the valuation model to get to the intrinsic value of companies in your own portfolio, do click on that pinned comment below. Also, let me know your thoughts about Arbor Realty Trust. Is this one you have in your portfolio, the one you're considering with the very high yield, or is it one that you are truly avoiding? As always, don't forget to like the video if you enjoyed, smash the like button. In fact, hit the subscribe and bell so you are continually notified of these gold videos as they drop. And as always, do not forget to have a great day. Catch you on the next episode and take care.